Have you ever wondered how you can trade stocks without quitting your day job? Today we're diving into swing trading, the perfect balance for busy professionals. Swing trading is the ultimate strategy for capturing market peaks and dips without the stress of day trading. Stick around to learn how you can make it work for you. What is swing trading? In effect, it is trading over several days as opposed to day trading or longer term trades. Why would you do that? So you're not watching the whole screen the whole time and can generally put in orders at the close or before the market opens. This allows you to keep working in another field, keeping your day job, while also making money trading. The market gets less competitive the longer the time frame is. For example, at the very short term end, if a retail investor tries to do high frequency trading, like in milliseconds, they need their brain examined. They're competing with the largest hedge funds and banks in the world. These funds have very complicated algorithms and super fast direct connections to the markets. Then, going one step slower, day trading. For say 5-minute or 1-hour trades, it's extremely competitive. Only a small fraction of traders beat commissions and other trading costs when day trading. Then we have swing trading, where trades can last from a couple of days to a few weeks. This is much less competitive than day trading. You can cover trading costs more easily because you have larger moves. And this is where most of my trading is. It is the optimal time frame for maximizing profits for a retail investor and doesn't take a lot of time once you've set up your systems. And then we have long-term investing, holding for several months or years, think Buffett. This is the least competitive area of trading, but you can take big losses while you wait for the gains. Curious about which markets offer the best opportunities for swing traders? Given the time frame, almost any market or stock can be found for swing trading. Even illiquid markets with wide spreads can be traded profitably on a swing basis. There is a trade-off between illiquid and liquid markets. Illiquid markets have higher costs, but usually more opportunities. They are less efficient, there is less competition. You want to choose markets or stocks which have some volatility. If the market doesn't move much, you will need to have larger positions to make the same profit. There are two problems with having larger positions. One, you will pay more interest if you're on margin, and at the current rates that's a lot. And two, you can experience larger losses if a big news event hits the market. So it's better to trade more volatile markets and stocks so you can use smaller sizes. As an example, trade 30-year bonds, not 5-year notes. Or trade Tesla instead of a stable utility or defensive stock. Wondering how to spot the perfect entry and exit points? You can swing trade with oscillation signals, which can be indicators or price action. Or you can swing trade with short-term trends. With oscillation trades, you buy after a dip and sell on an upswing. Or you short high and you cover low. With trends, you get on momentum, hoping it continues. And if it does, you run your wins long, you let them run. And if the trend turns around and goes against you, your trend indicators will get you out of the trade, so you cut your losses short. Buy low, sell high oscillation systems often have high win percentages, but the win sizes and loss sizes are usually similar. Oscillation indicators include RSI, stochastics, Williams R, and others. Price action can be recent lows or candlestick combinations, for example. With trend systems, you could win less than 50%, and you normally do, but you can have very big wins that more than pay for all the small losses, like 5 times the size of your losses. For indicators, generally moving averages and MACD work pretty well. They work as well as anything else, they're all pretty similar. Combining 2 trend indicators is usually helpful, particularly for the entries, so you get more robust entries. Your choice of oscillation or trend system depends on your nature, but I combine both. If you swing trade or have any questions about this, please comment below. You will hear me say in almost all my videos that you need to backtest your system. And you do. How else will you know if it works over time? You can't trust what you read in books, unfortunately. I once bought a trading book with 15 winning signals in it. I tested all of them. None of them worked. Not one. Crazy. I use WealthLab for backtesting and I recommend it. The link is in the description below. Now let's walk through some quick examples. What we see in front of us is WealthLab, and this is a system I've got, just a pretty simple oscillation system using Williams R. Buys when it's very low and sells after a few days. And you can see here, just buying low, the red triangle is selling high, sells after a few days. Again here, buying low, small profit, buying low, small profit, buying low, small loss there. Quite a solid profit there. Got a solid profit there, and a big profit there. So you can see oscillation systems often have lots of wins, but the wins and the losses, actually on this page, the wins are bigger than the losses, but normally the wins and losses are pretty similar. Then you have trend systems, which I mentioned, where you get in on a long trend and you'd probably, like you get in around here, you get in after the trend starts, you get in around where my arrow is, and you'd ride it all the way till it ends. And you end up having lots of false moves, so lots of losses, but then you get really big wins. Now, how do you protect your investments from unexpected market shifts? As per my last video, linked up here, I don't recommend using stop losses, as they generally don't add value and can make a system worse. For a similar reason, I don't recommend take profit levels. They can work sometimes, but not often. Take profit orders cut out big wins that can make you a lot of money. They get you small wins, many small wins, but that doesn't allow you to maximize returns. You can test this. Use the indicators in the price action to tell you what is happening in the market, when to get in and when to get out. Price action and indicators generally work better in backtests than arbitrary stop losses. For managing risk, sizing is critical, as is trading psychology, so you stick to your system. For more information on psychology and sizing, take a look at this video up here. If you want to become a better trader, please subscribe or join my Patreon, linked below, to get more customized content and Q&A.